All right, today we're going to tackle a big one, LIC's Jeevan Labh. We're going to break down exactly what it is, how it works, and who it's really for. And we're going to do it all in just a few minutes. So let's jump right in. You know, it's the classic financial balancing act, isn't it? On one hand, you're trying to save up for your own future, for retirement, for big goals. But on the other, you've got to make sure your family is protected right now if something happens. And it feels like you're forced to pick one, right? Well, that's exactly where a plan like Jeevan Labh tries to fit in. It's built from the ground up to do both of those things at once, to be your safety net and your savings piggy bank, all rolled into one. Okay, so here's the game plan. We'll start with the big idea behind it. Then we'll look at the actual benefits. After that, how you can tweak it to fit your needs. Then we'll look at some real-world numbers. And finally, super important, we'll cover the fine print. Let's do it. So first things first, what is this thing at its core? Let's strip away all the jargon and just get to the basic concept. Okay, you see these terms par and non-linked, and they sound complicated, right? But they're not. Par just means participating. Think of it this way. If the insurance company does well, you get a piece of the profits as a bonus. And non-linked? That's huge. It means your money isn't riding the roller coaster of the stock market. It's designed to be more stable. And this is probably the biggest selling point of the whole plan. You only pay your premiums for a limited time, but your life insurance coverage, that lasts for the entire policy term. So you could be done paying in your 40s, but you're still covered well into your 50s or 60s. And you're not locked into just one option either. You've got choices. You can get a 16-year policy but only pay for 10 years, or a 21-year term and pay for 15, or a 25-year plan where you pay for 16. The big idea here is you can line up your payments with your prime earning years, get them done, and then just let the policy's protection run its course. Okay, that all sounds good, but what about the money? When it all comes down to it, what do you or your family actually get out of this? This slide really lays it out perfectly. Think of it as having two different outcomes. If the unthinkable happens, your family gets the death benefit. That's the core amount you're insured for, plus all the bonuses earned so far. But if you live through the whole term, you get the maturity benefit. Same deal, the core amount plus all those bonuses. It's that 2-for-1 deal we talked about. So what are these bonuses we keep mentioning? Well, the simple reversionary bonus is basically an annual top-up. Each year the company declares it, it gets added to your policy's value. Then there's also a potential final additional bonus, which is like a one-time cherry on top when the policy ends, either through death or maturity. Okay, so the basic plan is solid, but our lives aren't one size fits all, right? So what if you want to tweak it? Let's talk about customization. Think of these as little power-ups for your policy. They're called riders. For a little extra cost, you can add on extra protection for things like accidents or disability. You can even add a rider that says if something happens to you, the company will pay the future premiums for you. It's all about tailoring the plan to cover your specific worries. Now this is a really cool feature. Instead of getting one giant check at the end, which, let's be honest, can be a little overwhelming to manage, you can choose to get the money in installments, like a regular paycheck over 5, 10, or 15 years. This can be an amazing tool for budgeting, both for you and for your family. All right, enough with the theory, let's talk actual numbers. I'm gonna walk you through an example, and this comes straight from the official brochure, so you can see how it might play out. So look at this number, 3,70,000 rupees. That's the projected payout for a 30-year-old who takes a 25-year plan with a 2 lakh sum assured. Now, hold on, this is super important. This is just an illustration. It assumes an 8% return every year, which is absolutely not guaranteed. It's just to give you an idea. And this table really paints the picture. You can see the total premiums paid over those 16 years add up to just over 1,60,000. Then, at the end of the 25 years, the potential payout could be 3,70,000. Again, this is with that assumed 8% return, so your actual results could be different, but it shows you the potential growth. Okay, let's get into the nitty-gritty, the fine print. This is the stuff you absolutely need to know to be a smart policyholder. This is a question I get all the time. I mean, life happens, right? Things get busy, finances get tight, so what happens if you miss a payment? So here's the deal. After a 30-day grace period, your policy lapses. But don't panic, you have a pretty long window, up to 5 years, to bring it back to life. You just have to pay the premiums you missed, plus some interest, and you might have to prove you're still in good health. But there's a clear path to get back on track. But what if you hit a rough patch and need some cash? Is your money just locked up forever? Nope. After you've paid premiums for a full year, you've got options. You can take out a loan against the policy's value, or you can just surrender it completely and get a cash value back. So there is some flexibility there if you need it. And that brings us right back to where we started. A plan where you pay for a shorter time but get long-term protection and savings. The real question is, does that 2-in-1 approach fit your financial journey? It's something to really think about. Thanks for tuning in.